Hello everyone. In this video we are going to learn accounting treatment of accumulated profit, losses, workmen compensation reserve and investment fluctuation reserve at the time of reconstitution of partnership firm. It means accounting treatment of these items when there is a change in profit sharing ratio amongst the existing partner, or it is a case of admission of a new partner, or it can be a case of retirement or death of an existing partner. Before starting this, let's understand the meaning of accumulated profits, losses and reserve. As we know, accumulated profits and reserves are undistributed profits and reserves that were kept aside for strengthening the financial position of an organization. For example, general reserve, contingency reserve, credit balance of profit and loss account. Accumulated losses are the expenses or losses that were shown in the asset sides of the balance sheet and that will be written off in more than one accounting period. For example, debit balance of profit and loss account or deferred revenue expenditure. Deferred revenue expenditures are the heavy or large advertisement or marketing expenses. So what will the treatment of these accumulated profit and losses at the time of reconstitution of partnership firm? There are two methods for this. According to first methods, when reserves and accumulated profits and losses are to be transferred to capital account, and according to second method, when reserves and accumulated profit and losses are to be retained in the books. In this video, I am going to discuss only the first method with you, and according to this method, what we have to done, we have to transfer the all accumulated profits and losses to partners capital account. Which partners capital account? Old partners capital account in old ratio. Why old partners? Because these accumulated profits and reserves were created before the reconstitution of partnership firm, hence these belongs to old partners only. That is why we will transfer it to old partners capital or current account. When we will use capital account, if the method for preparation of the capital account is fluctuating, that time we will use capital account, and if fixed capital method is following, then we will use current account. So according to our first method, what we have to done, we have to transfer all the accumulated profits and reserve that were shown in the old balance sheet. We have to transfer these accumulated profit and reserve to old partners capital account in old ratio. Workmen compensation reserve and investment fluctuation reserve, there can be different cases related to these cases. I will discuss these two reserves in details later on in this video, but for now you just understand this. If no other information is given for these two reserves, then the whole reserve will be transferred to old partners capital account in old ratio. As we have transferred the accumulated losses in the same accumulated profit, in the same way we will transfer the accumulated losses also. These accumulated losses will bear by the old partners in old ratio. Then what will be our entry? Old partners capital or current account debit to profit and loss account and to deferred revenue expenditures account. These are the examples of accumulated losses. If our question is silent about which method we have to adopt, first method or second method, then we will go for first method. If our question is silent, then we will use the first method, where we are transferring the accumulated profit, losses and reserve to old partners capital account in old ratio. Now let's understand this by taking this question. Here is the question, and it is a case of reconstitution of partnership firm because of change in profit sharing ratio. You can see on that date of reconstitution, the following items appearing in the old balance sheet: credit balance of profit and loss account, general reserve, workmen compensation reserve and advertisement suspense account. So these are the accumulated profit and losses. So according to first method, what we have to done, we have to transfer it to partners capital account. So in your first entry, you can see that all accumulated profit and reserves we have transferred it to old partners capital account in old ratio, and in the second entry we have transferred the accumulated losses to old partners capital account in old ratio. Now workmen compensation reserve. Workman compensation reserve, it is an specific reserve, we can say that, and it is created to compensate the employees if any mishappening or accident happens with the employees while they are working in the organization. So what could be the different cases for this reserves? First case is if there is no claim against workman compensation reserve. It means there is no liability arising against these reserves. Then what we have to done? We have to distribute the whole reserve amongst the old partners in old ratio, because the reserves remains unutilized. Now let's understand this by taking this example. You can see here are two partners, and in their old balance sheet workman compensation stood 40,000, and according to additional information what is given, if there is no other information, it means no liability arising against this reserve. So what we have to done, according to our first method, we have to transfer the whole reserve to old partners capital account in old ratios. You can see the solution in this entry. WCR transfer to old partners capital account in old ratio. What could be the other situation? If the claim for workman compensation is lower than the amount of workman compensation reserve, it means this time liability is arising against the workman compensation reserve, then we will adjust this liability through the workman compensation reserve, as we have reserve for this liability. So we will adjust first this liability towards our workman compensation reserve, and if still amount remain in the workman compensation reserve, the remaining amount will be distributed among the old partners in old ratio. So what will be our entry? Workman compensation reserve account debit to old partners capital account credit to provision for workman compensation claim account. Now let's understand this by taking this problem. As you can see in the balance sheet, workman compensation is given 40,000 and liability arising against is 25,000. Additional information, in addition information, it is given that liability arising against is 25,000. So 25,000, this liability will be adjusted through workman compensation reserve, and the remaining amounts will be distributed amongst the old partner in old ratio. Then what our entry will goes like this: workman compensation reserve account debit to provision for workman compensation claim account to old partners capital account. While you will preparing the balance sheet of new partnership firm, on the liability side you will show this liability, provision for workman compensation claim account at rupees 25,000. Now let's see what could be the other situations. If the claim is equal to workman compensation reserve, it means the liability arising against this reserve is equal to the amount of reserve. It means the whole reserve will be utilized for adjusting this liability. Then what will be our entry? Workman compensation reserve account debit to provision for workman compensation claim account. Now let's understand this by taking this example. You can see in old balance sheet workman compensation reserve stood 40,000, and according to additional information, liability as arising 40,000. So the liability arising is equal to the amount of reserve. Then we can adjust this loss towards this reserve. So our entry will be WCR account debit to provision for workman compensation claim account. What could be the other case? If the claim is more than the amount of workman compensation reserve account, it means liability arising is more than the available reserve. Then what will we do? As we know that increase in the liabilities are done, adjustment for increase in the liabilities are done through revaluation account, then the increase in liability will be transferred to revaluation account. That time what will be our entry? Workman compensation reserve account debit, revaluation account debit to provision for workman compensation claim account. It means here is the liability is more than the reserve, that is why the excess liability will be transferred to revaluation account. And what will in this case there will be a second entry, because loss arising in under revaluation account because of increase in liability, then this loss, revaluation loss, will be transferred to partners capital account. Then what will be our second entry? Old partners capital or current account debit to revaluation account. Now let's understand this these two entries by taking this example. You can see the workman compensation reserve stood 40,000 and the liability against this arising 50,000. It is more than the available reserve. It means we have to transfer the excess liability to revaluation account. Then our entry will be workman compensation reserve account debit, revaluation account debit to provision for workman compensation claim account, and this revaluation loss will be transferred to partners capital account. Then our second entry will be old partners capital account debit to revaluation account. It means we have distributed the revaluation loss amongst the old partners. Then investment fluctuation reserve, it is also a specific reserve which is created to meet the shortfall in the market value of the investment. So what could be the different cases related to this reserve? First case is when book value and market value of the investment is same. It means it is a case of no profit and no loss. So it means the whole reserve will be remain unutilized. So what we have to done, we have to transfer the whole reserve into old partners capital account or current account. So what will be our entry? Investment fluctuation reserve account debit to old partners capital or current account. Now let's understand this by taking this example. In old balance sheet, investment fluctuation reserve stood 54,000 and book value of investment is given 6 lakh and nothing is given in additional information. So we will assume that investment market value of investment is same as book value of the investment. So it is a case of no profit, no loss. The whole reserve will be distributed amongst the old partner in old ratio. So you can see the solution. We have distributed the IFR amongst the old partners in old ratio. What could be the other cases? When market value of investment is less than the book value. So for this case there can be three possibilities. We will look on the first possibilities. Fall in the value is less than the investment fluctuation reserve. It means loss arising due to decrease in the value of investment is less than the available reserve. So that time this loss can be settled through this reserve and the still amount remains in the investment fluctuation reserve. Then this remaining amount will be distributed amongst the old partner in old profit sharing ratio. Then what will be our entry? Investment fluctuation reserve account debit to investment account to old partners capital or current account. Why we have credit investment account? Because value of investment is decreasing. That is why we will credit it, and this loss we can adjust it through investment fluctuation reserve. Now let's understand this entry by this example. You can see in the old balance sheet IFR stood 54,000 and the book value of investment is 6 lakh, and according to additional information market value of investment is 5,91,000. So we are seeing that investment there is a reduction in the value of investment of rupees 9,000 and we have reserve 54,000. So this loss can be adjusted against this reserve and still amount remaining in this reserve that will be distributed amongst the old partners in old ratio. So here goes the entries: investment fluctuation reserve account debit to investment account to old partners capital account. Now what could be the other situation? Fall in the value is equal to the investment fluctuation reserve. It means this time the loss arising due to fall in the investment value of investment is the equal to the amount of investment fluctuation reserve. Then this loss, we can cover this loss by the investment fluctuation reserve. Then what will be our entry? IFR account debit to investment account. Now let's understand this entry by taking this example. In old balance sheet IFR stood 54,000 and book value of investment is 6 lakh and the market value of investment is 5,46,000. So you can see that there is a reduction in the value of investment of rupees 54,000, which is equal to investment fluctuation reserve. Then this whole loss we will recover it from investment fluctuation reserve. Then our entry will be investment fluctuation reserve account debit to investment. What could be the other cases? Fall in the value is more than the investment fluctuation reserve. This time the loss arising due to fall in the value of investment is more than the available reserve. Then this the excess loss. How we will adjust it? We will adjust it through revaluation account. As we know that decrease and increase in the value of assets and liabilities are adjusted through revaluation account at the time of reconstitution of partnership firm. Then what will be our entry? Investment fluctuation reserve account debit, revaluation account debit to investment account. We have debited the revaluation account to meet the loss arising due to decrease in the value of investment. And as there is a revaluation loss, so there will be a second entry, and this will be for transferring this loss to old partners capital account. Then what will be our entry? Old partners capital or current account debit to revaluation account. Now let's understand these two entries by taking this example. In old balance sheet, IFR stood 54,000, investment book value is 6 lakhs, and according to additional information, investment market value is 5,28,000. So we can see that reduction in investment value is 72,000, which is more than the investment fluctuation reserve. So out of the total losses of rupees 72,000, out of this 72,000, 54,000 we will adjust through investment fluctuation reserve, and remaining 18,000 we have to adjust it by transferring it to revaluation account. Then our entry will be investment fluctuation reserve account debit, revaluation account debit to investment. And here is a loss in revaluation account. Then revaluation loss will be debited to partners capital account. Then our second entry will be partners capital account debit to revaluation account. It means we have transferred the revaluation loss to partners capital account. What could be the other situation? When market value of investment is more than the book value, it means it is a case of profit. Profit is arising due to increase in the market value of the investment. It means in this case the whole investment fluctuation reserve will be remains unutilized. So what we have to done, we have to transfer the whole reserve to old partners capital or current account. This will be our first entry, investment fluctuation reserve account debit to old partners capital or current account. Now there is a profit, so we will transfer this profit to revaluation account. It means increase in the value of investment will be transferred to revaluation account. Then what will be done? Investment account debit to revaluation account. As there is a profit in revaluation account, so we have to distribute this revaluation profit amongst the old partners in old ratio. Then what will be our third entry? For transferring this profit, revaluation account debit to old partners capital or current account. Now let's understand these three entries by taking this example. In balance sheet, IFR stood rupees 54,000, and book value of the investment is 6 lakh. And the market value according to additional information, it is 6,60,000. So you can see there is an increase in the value of investment of rupees 60,000. It means investment fluctuation reserves remains unutilized. So according to our first method, what we have to done, the whole reserve will be transferred to old partners capital account. You can see the entry, first entry we have transferred the whole reserve into old partners capital account. Now there is a profit because of interest, because of increase in the value of investment. Then this profit will be transferred to revaluation account. So here is the second entry, investment account debit to revaluation account. Now what we have to done, we have to transfer this revaluation profit to old partners capital account. Then our third entry will be for transferring this revaluation profit to old partners capital accounts. So that was all in this video. I am Hemlata, PGT Commerce from KV Sevak Road. Jai Hind, Jai Bharat.